Conagra Brands closed fiscal 2026 with a net loss of nearly $1.92 billion. Diluted earnings per share, minus $4 against a positive $2.40 a year earlier, a swing of more than 260%. Yet in the same 12 months, the company generated $1.4 billion of cash from operations and paid out nearly $670 million in dividends. Both facts cannot describe a business in collapse. So what happened? The answer sits in the gap between accounting earnings and cash. Conagra Brands is a United States packaged food company listed on the New York Stock Exchange, reporting in dollars. Fiscal 2026 ran to the 31st of May, 2026, and the results come from the 10-K filed on the 15th of July. Total revenue was $11.28 billion across 6 reported product groups: frozen, other shelf-stable, snacks, food service, international, and refrigerated. Consumer staples, steady categories, thin growth, and margins that matter more than volume. What follows is a story about margins, write-downs, and cash, not demand falling off a cliff. The headline numbers for the full fiscal year. Revenue was $11.28 billion, down 2.9% from $11.61 billion. Gross profit fell harder, down 10.2% to $2.7 billion. Operating income came in at a loss of $1.63 billion, against a profit of $1.36 billion the year before, a swing of 219%. Pre-tax income was a loss of $1.82 billion, and Conagra still booked $91.8 million of tax expense against that loss, taking the net result to a loss of $1.92 billion. Diluted earnings per share, minus $4. Rebuild the operating result from the top. Gross profit was $2.7 billion. Subtract selling, general, and administrative expense of $1.44 billion and research and development of $62.7 million. That leaves roughly $1.2 billion of operating profit. But the company reported an operating loss of $1.63 billion. The gap is about $2.8 billion, and it sits below the expense lines we can see, the signature of a large non-cash write-down of goodwill or brand value. 2 numbers corroborated. Total assets fell by $3.66 billion over the year, and retained earnings dropped by $2.59 billion. Operating cash flow stayed at $1.4 billion. Cash did not leave the building. Carrying value did. Where the revenue comes from. 6 product groups. Frozen is the anchor at $3.92 billion, 34.7% of the total, and essentially flat, down 0.7%. Snacks is the growth engine. $2.23 billion, up 5.5%, now 19.7% of revenue. Between them sits the problem. Other shelf-stable brought in $2.38 billion, down 14.6%, a drop of roughly $406 million year-on-year. That single segment is more than the entire company's revenue decline of $331 million. Without other shelf-stable, Conagra's top line would have grown. 3 segments, 75% of revenue, 1 doing all the damage. The remaining quarter splits 3 ways. Food service, the away-from-home channel, did $1.12 billion, up 1.9%, just under 10% of revenue. International came in at $914 million, down 4.5%, 8.1% of the total, the second largest decliner after other shelf-stable. Refrigerated was $725 million, up 1.2%. Rank them by direction. Snacks up 5.5, food service up 1.9, refrigerated up 1.2, frozen roughly flat, international down 4.5, other shelf-stable down 14.6. 4 of 6 segments held or grew. The decline is concentrated, not broad. Look at all 3 reported years. Revenue, $12.05 billion in fiscal 2024, $11.61 billion in 2025, $11.28 billion in 2026. 2 consecutive declines, about $770 million of revenue gone. Gross margin, 27.7%, then 25.9, now 23.9, down 3.8 percentage points in 2 years, and the erosion did not slow. Operating cash flow, 2.02 billion, 1.69 billion, 1.4 billion. Free cash flow, 1.63 billion, 1.3 billion, 979 million. Every line points the same way. The impairment is this year's event. The compression is a trend. Walk the margin bridge. Revenue fell 2.9%, but cost of revenue barely moved. 8.58 billion versus 8.61 billion, down just 0.3%. Costs held while sales fell, and that alone takes gross margin from 25.9% to 23.9%. Operating expenses helped. SG&A came down 6.4% to $1.44 billion. Yet operating margin still went from positive 11.8% to negative 14.4%, a swing driven entirely by the charge below those lines. Net margin finished at negative 17%, made slightly worse by that $92 million tax expense on a pre-tax loss. Return on equity, minus 30.1% against positive 12.9% a year ago. The cash statement tells a different story. Operating cash flow was $1.4 billion, down 17.1%, but firmly positive. Capital expenditure was $423 million, above last year's $389 million. That leaves free cash flow of $979 million. Dividends paid were $670 million, unchanged for 3 years, covered by free cash flow with about $309 million to spare. Buybacks were minimal at $15.3 million, down from $64 million. Investing cash flow turned positive, plus $263 million against minus $542 million last year. Financing was minus $1.52 billion. Depreciation and amortization of $396 million is nowhere near big enough to explain the loss, which again points to a one-off charge. The balance sheet is where the write-down lands. Total assets fell 17.5% to $17.27 billion. Total liabilities came down 9% to $10.92 billion. But equity fell far faster, down 28.8% to $6.36 billion, with retained earnings dropping from $6.76 billion to $4.17 billion. That $2.59 billion fall lines up with the $1.92 billion loss, plus the $670 million of dividends. Long-term debt did not shrink. It rose slightly to $6.46 billion. Same debt, smaller equity base. So debt to equity climbed to 1.72 times from 1.34. The leverage came from the equity being written down, not from borrowing. Liquidity improved but stays tight. The current ratio is 0.9, up from 0.71, still under 1. Cash rose to $218 million from $68 million. What about the people who know the business best? Nothing. The Form 4 record for this window shows 0 open market buys and 0 open market sells. No directors, no officers, no 10% owners transacting. No insider signal in either direction. Silence is not a vote of confidence and not a warning. The event flow is equally quiet. 2 8K filings. On the 15th of July, Conagra furnished its fourth quarter earnings release, with no financial detail in the filing text. On the 23rd of June, the company disclosed that Director Emmanuel Chirico will not stand for re-election at the September 2026 annual meeting, finishing his current term, with the company stating the departure was not due to any disagreement with the board. Routine. 4 things to track. First, whether the charge is genuinely one-off. Does operating income return to positive on the next print? The clean run rate implied by this filing is roughly $1.2 billion of operating profit, so that is the bar. Second, gross margin. 23.9% after 2 years of erosion. Does it stabilize, or is there a fourth leg down? Third, other shelf stable, which alone accounts for more than the whole revenue decline, so its stabilization matters most. Fourth, dividend coverage. Free cash flow of $979 million against $670 million of dividends leaves real but not unlimited room. and free cash flow has fallen in each of the last 3 years. One line to take away. Conagra's fiscal 2026 loss is an accounting event, but the erosion underneath it is real. The $1.92 billion loss and the -$4 earnings per share are not run rate. $1.4 billion of operating cash flow and a covered dividend say the cash engine still works. What is not an accounting artifact is revenue down for a second straight year, gross margin down 3.8 points in two, and equity down 29% with leverage at 1.72 times. A cash-solid staples business working through asset value stress and margin pressure, not an operational cash collapse. Everything here comes from the 10K. Figures only, no advice.